Thanks for watching Lessons in Minutes with Jaylee. Like, share, and don't forget to subscribe.
Today's topic is incorporation of an unincorporated business. At the end of this lesson, you should be able to demonstrate how to incorporate a partnership business. So you should, at the end of the lesson, know how to incorporate a partnership business. Now, what is an unincorporated business? What is an unincorporated business? That's a business that does not possess a legal entity. So an unincorporated business is one that does not possess a legal entity, right? And we know, for example, that a company is a legal entity. A legal entity, remember, this is separate, the business is separate and apart from its owner. So the business can be sued or it can sue others or other companies. Examples of an unincorporated business. Now, you're seeing one person right there. So a sole trader is an example of an unincorporated business. Now, another example is a partnership. So two examples of unincorporated business are a sole trader business and a partnership business, or even a family trust. So those are examples of an unincorporated business. Now, why incorporate? Why incorporate an unincorporated business? Why would, for example, a sole trader or a partnership go through that process of incorporating? And we're going to look at some scenarios. So the first one is where they're able to generate more capital. So that would be more capital for the firm. And in this case, remember, if you have one person, you're unable to supply the capital to run the business. You may be unable to supply the capital because all of that burden is on you and you alone. For the partnership, yes, there are more than one person. However, there may be difficulties in generating the amount of capital that you'll need to basically say you're going to expand. So in generating more capital, then of course, it means that if you incorporate into a company, you'll be able to sell your shares. And in selling shares, then of course, you'll be able to generate more capital. Another is limited liability of the shareholders. Another unlimited life, because we know that a company, or unlike a partnership, if one of the partner died, then of course the business basically collapses as well, right? However, for the company, if it is that there is a shareholder that dies, then of course the business still lives on. Because remember, the business is separate from its owner. So there's continuity in the lifespan of the business. So those are some examples. What is the incorporation effect on, for example, a partnership? What is the effect? So let's look at that. The first effect there is that when the partnership is converted into a company, the partners' relation changes to shareholders. So now you're not going to refer to them as partners of the business. They're now referred to as shareholders, because definitely what they'll be doing is purchasing shares in the company. And remember, persons that purchase shares within a company, or you can say stock, the very same thing, then they are referred to as shareholders. So they're owners of the business. The books of the partnership are closed and new books are opened for the corporation. So whatever is that was in the partnership books, those are closed. So whatever assets, liabilities that are within that business, those are closed. And therefore, you now have within that corporation, the assets, the liabilities coming from the partnership business that is now incorporated, and the issuance of stock, because remember, you're changing over from partnership to a company. So therefore, stocks will be issued. So to the partners that are converting to the corporation, their capital would then be used to purchase stock. And it is based on the amount of capital that they have in the business that they'll be able to purchase shares. In addition to that, to the effect, Partners' capital balances are adjusted based on gains or losses in revaluation and is used to acquire the stock. Earlier I mentioned that the capital is what is used to purchase the stock within the new business, a corporation, that incorporated business now. And in terms of their capital balances, in going through the process to convert from the unincorporated to a corporation, you'll find that there may be gains or losses, right? And those will affect the capital balances of the partners. You'll see that through the demonstration. So here's our work example. The question that we're using: Jay, Moya, and Tara operate a successful pharmacy as partners. They decide to convert into a shopping mall. They decided to incorporate the business into Sam's Limited to benefit from the advantages of running a limited liability company. So they're changing from a partnership into a company, and it is now called Sam's Limited. Sam's authorized capital is 200,000 ordinary shares, par value $8. The following is the balance sheet of the partnership prior to the announcement of the incorporation. The book values and the current fair values are provided by the business. You're required to show the entries to record the incorporation of the partnership, assuming that the new company issues 80,000 ordinary shares to the partners. The opening balance sheet of Sam's as at January 1st, 2021. So this information right here is important to you, their profit sharing ratio. They're sharing profits in the ratio of 5 to 3 to 2 respectively. When in the conversion process, whatever gain or loss that is shared among the partners using their profit and loss sharing ratio. So you're presented with the book value and the fair value of the business, and remember they are incorporating, and once you have the book value, the fair value, you're going to compare those two, and the fair value may be the same as the book value, or there may be changes in the sense that it may increase or the item may decrease. Now, if it is that there's a change in the item, you would use your double entry rule in order to show that effect. Your double entry rule, remember, that indicates what you're to do if there's an increase in the item or if there's a reduction in the item, right? So that rule, the double entry rules, are very important in the conversion process. Now that we have gone through the question, read it, we're now going to pick up some of the important things from the question, and that is key. So the partners, they're converting from a partnership over into a limited liability company called Sam's Limited. So the business is called Sam's Limited. Sam's has an authorized capital of 200,000 ordinary shares with par value of $8 per share. Now, in the question, you're presented with the book value as well as the fair value. Now, what are we going to do with these values? You're going to compare them to determine if there is an increase or decrease. Now, based on the change, you're going to use the double entry rule to aid in the conversion process. The double entry rule is used in the conversion process. If there's an increase in the item, by using your double entry rule, you would know whether or not you would be debiting or crediting. Now, we're going to use a temporary account called a valuation adjustment account to aid in the conversion process. So that is our temporary account that we're going to use to aid in the conversion process, meaning we're going to use that account to aid in completing the double entry. So here we go. You have to compare the book value and the fair value, as I said. Some items may change, some may not. So premises, book value 500, fair value same 500. Motor vehicle, book value was 350. Now we're seeing that there is a reduction. So it stands at 300,000. What is the value that it decreases by? That's the difference between 350 and the 300,000, and that give us 50,000. Because this item is an asset and there is a reduction, we are going to credit. Next, inventory. Original figure is 120,000, and we're seeing that the fair value is 130. So therefore, based on assessment, there's an increase of the difference between the two figures, which give us $10,000. This is an asset again. When there is an increase in the asset, you are to debit the asset account. Bank, there's no change. Book value and fair value is the same. Cash, no change as well. However, for our accounts receivable, we noticed that our book value was 55,000. Now it is 52,000. So therefore, there is a reduction of the difference between the two figures, which is 3,000. Accounts receivable is an asset and there's a reduction. So therefore, you're going to credit. Over to our liabilities. Let's do our assessment. There's no change for accounts payable. However, for the loan, we're seeing where the book value was 180,000. Now it is 172,000. That indicates that there is a reduction, and the value that it decreases by is $8,000. Liability, when there is a reduction, you are to debit using the double entry rule. We're now going to look at mortgage. Mortgage was 400,000. Now it is 330,000. So there is a reduction in this item as well. And the difference, the amount it decreases by is 70,000. Because this item is a liability, we are going to debit. Now, so we have 5 items that have changed based on the fair value, comparing fair with the book value. And we have 3 items to be debited, and we have 2 items to be credited. So when we're going to use the general journal to aid in the conversion process. So in your general journal, remember, you list your debit items first, and then your credit item is indented and listed after. So it must be indented. Debit first, then credit. So we're going to go over to our response and look at the general journal entries. Now, here we are with the general journal. Remember, we have looked at the items that have changed, and there are 3 items to be debited. So the items to be debited are inventory, the loan, the mortgage, and you put the amount, which was the difference between the book value and the fair value. The 2 items to be credited are motor vehicle and accounts receivable. Remember, we have looked at the changes, and based on the changes, we use the double entry rule to know whether or not we're going to debit or credit. So those were the 5 items that changed. Now comparing our debit with our credit column of the journal. This, our debit, is a total of 88,000, while our credit is 53,000. There is a difference of 35,000 on the credit side. That 35,000 is placed in the valuation adjustment account. So there's a credit balance in the valuation adjustment account. And our totals for the general journal is 88,000 for each column. So our totals 88,000. What are we going to do with this 35,000? That $35,000 is shared between the partners. So we have a value of 35,000 coming from the valuation adjustment account. And we're going to share this among the three partners. And remember, their profit sharing ratio is 5 to 3 to 2 respectively. So let us go ahead and share that 35,000. We're going to start with J. It is 5 to 3 to 2. And J is getting 5. So J is going to get 5 out of the total of 10, which is a half of the 35,000. And that gives us a value of 17,500. Our next partner, which is Maya. So we're going to share for Maya now. And based on the ratio, profit sharing ratio, Maya is to receive 3/10 of the 35,000. 3/10 of the 35,000 give us 10,500. So J is getting 17,500. We have calculated for Maya, that is 10,500. Now we're going to look at Tara. Now, Tara, based on the profit sharing ratio, is to get 2/10. That is 2 divided by 10 times the value of 35,000. And that gives us 7,000. If you add up all of that, you should get back the very same value of 35,000. That is the balance that is in the valuation adjustment account. Now, remember 17,500, 10,500, and 7,000. So those are the value that each partner receive from the valuation adjustment. So based on that, remember the valuation adjustment account was credited with 35,000. That's a credit balance in the valuation adjustment account. So based on the 35,000 that is in the valuation adjustment account, we're going to look at the effect on the partner's capital to indicate whether there is an increase or a reduction in their capital values. So the credit balance, remember that is 35,000. Where there's a credit balance, please note that in the valuation account, that is, if there's a credit balance in the valuation adjustment account, that causes an increase in the partner's capital. So therefore, you are going to debit your valuation adjustment account and credit your partner's capital because that's an increase. However, if there is a reduction in the valuation adjustment account, meaning that there is a debit balance, there is a reduction in the partner's capital. So therefore, what you would do is to debit your partner's capital and credit your valuation adjustment. So this 35,000 that we have shared among the partners, we're now going to go into the journal and make those entries. Remember, because there is a credit balance, that results in an increase in the partner's capital. So therefore, we are now going to make the entries. So we're going to look at the entries in the general journal now relating to that. So here is our journal. Here is our journal. Our valuation adjustment account is debited with that 35,000 because this amount that was in the valuation adjustment on the credit side, you're now debiting the account because you're transferring that 35,000 that is in the valuation adjustment account over to your partner's capital account. And remember, that's an increase in the partner's worth, so therefore you are crediting. So J 17,500, Maya 10,500, and Tara 7,000. And when you're finished, you should get back the total of 35,000. We have looked at the increases and or decreases in the account. We have shown the effect on the partner's capital. Now we're going to calculate the new value for the partners. So we're going to start with J, because this information is very important because this amount that you have now in the partner's capital, it's going to determine how much shares the partner would be able to purchase. So J, original, let's go to the question to see what was the original capital value. J's capital value was 300,000. So we're now going to calculate J's new capital. So that is 300. So J, 300,000 plus the value that is coming from the adjustment, and that was 17,500. There was a gain. So we're adding that 17,500, and that would give us a new capital for J of $317,500. Let's look at Maya. Maya's original capital value is 260,000. So that 260,000 is added to the gain coming from the conversion, and Maya got $10,500 more. So we're adding that, and that gives us a value of 270,500 for Maya. And the final partner, which is Tara, we need to look at our original capital balance, and that was 205,000. So it is 205,000 plus the 7,000 gain that she got. So coming from the journal with the share of the gain, remember, use the profit sharing ratio to do that. My Tara got 7,000, so that is 205,000 plus the 7,000, which give us $212,000. So these are the new capital values. These capital values, now you're going to use them to purchase shares in the new business, which is Sam's Limited. So let's look at the journal entry. The journal entry for that, first you have to look at the amount of shares, right? So the amount of shares that were sold, remember, that is 80,000 shares. 80,000 shares sold, and the par value is very important. The par value, remember, that was $8 per share. So in calculating 80,000 times the par value of 8 would give us a share capital that is raised from that of 640,000. Now, if it is that the partner's value is greater than the share capital, then it means that the extra, that is the difference between the partner's capital value and the share capital value, would then be placed in what we call share premium. So let us determine, we're going to look at the journal to determine if there is any share premium. So let us take a look at the journal. So here is a journal, right? And before I even reveal the results, remember, in looking at the conversion, the capital that the partner has is then transferred to the new business, and that is used to purchase shares in the business. So there will no longer, the relation, remember, the relation is no longer partners, But because they're now purchasing shares, they're now referred to as shareholders in the firm. So we're going to transfer that value from the partner's capital account over to the share capital account. So in doing that, we're reducing the partner's capital, and so our partner's capital account is debited. So let's look at the first one. J is debited with 317,000. Maya is debited with 270,000. And Tara is debited with 212,000. So J, 317,500. Maya, 270,500. And Tara, $212,000. And these figures, remember, that's a new capital value. And because there was a gain, the capital increased for each partner. And by debiting the journal, what we're doing is transferring the value that is in the partner's capital account over to the share capital. So hence we're reducing the partner's capital. Now, because we have sold shares to the partners, they are no longer partners, they are now shareholders, and the share capital raised from that is 640,000. Remember earlier, our calculation is the number of shares sold times the par value of the shares, which is 8, and that gave us 640,000. Let's determine if there is a share premium. The total of our debit, you're going to total your debit, and you would get a total of 800,000. The share capital is only 640,000. The difference would give us share premium, and that difference is $160,000. So that is our journal showing the purchase of the shares. So this is our journal entries showing the partner's capital used to purchase the shares. If you remember, once your partner's capital is greater than the share capital, there is the excess goes to share premium. Now that we have that, we can then prepare the balance sheet of Sam's Limited. So remember, before I go over to the balance sheet, the first thing that you do, you compare the values. And when you compare the values, if there's an increase or a decrease in the difference between the book value and the fair value, you would then use your double entry rule to determine whether or not you're going to debit or credit. We did that in the first journal, and we noticed that there is a difference on the credit side, and then that is sent to our temporary account called the valuation adjustment account. Because it is a credit balance that resulted in an increase in the partner's capital, and you share that 35,000, whatever value it is in the valuation adjustment account. In this case, it is 35,000. You share that among the partners using their profit sharing ratio. That value, then you show the calculation of the new capital. And upon showing the calculation of the new capital, when you're finished with that, you use that now to purchase the shares in the company. How do we arrive by the share capital? It is the number of shares sold times the par value. If there is any excess, meaning if your partner's capital, the total capital of your partners is greater than your ordinary share capital, or it could be referred to as common share capital, then the excess would go to your paid-in capital, which is your share premium account. You have that now. What you can then do is use the fair values from the question along with this information. So what we're going to do now is use the values coming from the question, the fair value, along with this information to prepare the opening balance sheet. So what we're pulling from what we have done earlier is the ordinary share capital and the share premium. Remember, we no longer have partners. Those three individuals are now shareholders because we're converting the business. So we're going to prepare the balance sheet now to see the conversion process was successful. So we'll be looking at the question and then use that to prepare our balance sheet. So going to the question, remember we're using the fair values and we begin with our assets. And we have premises and we have motor vehicle. Premises is 500,000, motor vehicle is 300,000. Let's put in those values. For non-current assets, premises, remember your use is either you're using order of permanence or order of liquidity. Remember your order is important. And I'm going by way of order of permanence. And our premises value is 500,000. Remember, you're using the fair value. We're using the fair value in doing our opening balance sheet. These are the values that the business was assessed, and now they are the new values, so we're using those. Our next item is the motor vehicle. And the motor vehicle new value is 300,000, and that gives us a total of 800,000. And we're now going to move into our current assets. So next heading, current assets. So the first one in terms of the order is inventory, and the inventory value is 130,000. That was a fair value. Remember, we're using the fair value, the new values, and we have accounts receivable, or accounts receivable is accounts receivable value, the new value there is 52,000. Next, we have prepayments, and the prepayment value is 30,000. That had remained at the same value of the book value. Bank, remember what we're doing is picking up the new values. We're working with the fair values. That's what you're using to do the opening balance sheet. You have converted the business based on the assessment. Some items changed, some didn't. Remember, you're using the fair value. Bank is 250,000, and our cash is 100,000. So let's go back to the question and double check if we pick up the right values. Yes, we did. So over to the current liabilities. We're going to move over, picking up our current liabilities, long-term liability, and we need our capital because the next section that we're working on is the share capital. But before we do that, we need to put in our total current assets and then our total assets, because I'm matching the assets against equity and the liabilities. Our total current asset is 562,000. Add that to the fixed assets, which is our non-current assets, and that's a total of $1,362,000. And to complete that, to show the total assets, remember, put your single line above and your double line below. That is referred to as total assets. So now we're looking at the equity and liabilities section, beginning with our ordinary share capital. And our ordinary share capital generated from the sale of the 80,000 shares is 640,000. And our share premium Share premium was 160,000. So we're going to put in that information into our balance sheet. Share premium. And that's 160,000. Add those two together, and that gives us a total of 800,000. So we're going to put in our liabilities now that we have entered our equity. And I'm going to start with long-term liability. And from the question, remember, there was only one long-term liability, which is mortgage, and that is 330,000. Remember, we are working with the fair values, that is 330. So let's put in that item, mortgage, and that is 330,000. Next, we're going to put in our current liabilities. And there were two. So in the question, we have accounts payable, 60,000. Let's put in that. Accounts payable, 60,000. And there is one more, which is the loan of 172,000. And that was loan from NCB, and that's 172,000. Add those together, we get a total of 232,000. So we're going to add up all those figures together to get our total. So our total is, after calculation, remember it's 800,000, which is your total equity and the share premium there, along with your mortgage of 330,000, your current liabilities of 232,000. That gives us a total of 1,362,000. And this is referred to as our total equity and liabilities. And once your total equity and liabilities matches with your total assets, we can safely say that the conversion was successful because our balance sheet is balanced. Okay? So just to review what was done in order to do the incorporation. So remember, in doing the conversion, what you're doing is to compare your book value and your fair value. Once there is a change in the value, whether increase or decrease, you're going to use your double entry rule to make that adjustment. So for example, if your asset increases, the difference, you're going to debit that. So in your general journal, you would debit, or in your ledger account, you make a debit entry. You use your valuation adjustment account as a temporary account to aid in the conversion process. That valuation account is what is used to complete double entry. The journal entries were done, and the valuation adjustment account, there was a credit balance of 35,000. What you do with the balance is to share it among the partners. Now, because it's a credit balance, there is an increase in the partners' capital because that's a gain. So therefore, you would debit your valuation adjustment and credit your partner's capital account. That was done in this journal. The next stage is to calculate a new capital for the partners. So that's the older capital value coming from the balance sheet plus the gain. If there was a reduction, you would have subtracted. The reduction would have been a debit entry to your capital account for the partners. And after you calculate that, you then use that to purchase the shares in the corporation, which is the new business, the incorporated business. And the capitals may be greater than the share capital value. If it is that the capitals are greater in total than the share capital value, the difference goes to your share premium. Remember, it is based on the number of shares that were sold times the par value that would give you the share capital. But there may be questions where they don't tell you how many shares were sold. What you would then do is to just use whatever amount of capital that you have for the partners and purchase that amount of shares. So for example, if they did not say that 80,000 shares were sold, all of that 800,000 in capital total for the partners would go to the share capital account. After doing that now, the fair values from the question, all of these that are highlighted are used to prepare the opening balance sheet for the new business, which is SAM in this case. And also, additional information that you need for that is information coming from this, where you show the purchase of the shares. So that is it. The purchase of the shares by the partners or the sale of the shares by the new business, which is SAMS, right? And remember, once the conversion process is done, then your balance sheet, upon preparation, once you're finished completing that, your balance sheet should then be balanced. And where the format that I've used is total assets equal to equity plus liabilities. And based on that, you're seeing that your total equity, so that's total equity and liabilities of 1,362,000 is the same as your total assets of 1,362,000. Once your balance sheet is balanced, then of course you can say that you have successfully converted that unincorporated business into an incorporated business. In this case, we had used a partnership business, converted that to a company. Now, one thing to add to your knowledge, say for example, you're given the book values and the fair values, and for the fair value, there is no fair value for an item. So for example, there wasn't any fair value for the premises. If there wasn't any fair value for the premises, in doing the conversion, you would not have premises in the new business. So what you would do is in the journal, because there is no fair value for the premises, it would be like there's a reduction in it. So you would then cancel out that 500 balance that is in your premises account by way of crediting the journal. So remember, once there is no fair value for a particular asset or a liability, then of course you're not going to take that over to the new business. What you will do is transfer that value to the valuation adjustment and close down that account. You're closing it completely, but nothing is going to your new business. Again, for example, if we had used the premises and there's no fair value for the premises, when your entries would be to credit your premises account, your valuation adjustment account is debited. In doing the new balance sheet, because there's no fair value for premises, no entry is made in the balance sheet for premises. And that is it for the conversion of an unincorporated business into an incorporated business.
Like, share, and don't forget to subscribe.